Welcome to Providence Hill Presents Exit Stage Right. This is the show where we talk about ways to build, buy, and sell your business so you can exit stage right into your next adventure and meet your financial goals. Whether you own your own company now, or you aspire to, or you are a key leader in your organization, this is a show where we're going to talk about the business of business and how you can set yourself up and your organization for its best and brightest future. Welcome. I'm your host, Martha Sullivan. Last week we spent a fair amount of time talking about a acquisition that Patricia, my client Patricia, and Tony, the owner of the business that was being purchased, what they were going through, and how they came up with very different numbers initially around what the business was worth and how much Patricia would pay for it. And they did start with very different numbers. Ultimately, they did come to an agreement on a purchase price. And as you may be aware, the purchase price, or the valuation of a company, is the function of essentially the buyer's perception of risk and the cash flow they believe that the company will generate under their ownership. And you often hear it expressed as a multiple of something, such as so-and-so sold their business for a multiple of 5, or a multiple of 10, or some number along those lines. And what that is usually a multiple of, in terms of that something, is usually on cash flow or the bottom line. The most common number that's used is called earnings before interest, taxes, depreciation, and amortization. EBITDA, that is the most common number that's used that you apply a multiple to. Buyers and sellers very often can come pretty easily to an agreement on what that EBITDA number should be, even after various adjustments, because essentially it comes pretty much right off the income statement, and you take your net income, you add back anything in corporate income taxes paid, depreciation, amortization, and interest. You add those back, and that's how you come up with EBITDA. And there might be special adjustments or things that they'll adjust for and normalize for as to what it would be like under the new ownership. But by and large, they can come to an agreement on that pretty easily. The question, though, is the multiple, and that's more mysterious. And so last week, as we were talking about it, I promised that we would dive into the mysterious multiple a little bit more, because I think to many sellers, it feels like the buyer is pulling the multiple out of thin air, or they're pulling it out of somewhere else. But there really isn't a broad understanding of where does the multiple come from. It's not from thin air, and that's what I want to talk about today, because sophisticated buyers are definitely not pulling it out of thin air. In our first segment this week, Rather Eat Nails, will break down exactly what the multiple is, and I'll walk you through the most common approach that is used in arriving at an income-driven value, and so how it's determined. And then in our second segment, we Shake Your Moneymaker, we will break it down in terms of what you can do in your own business and company to influence it, because you do have influence on it over the long term, your long-term ownership of the company. So let's dive into it, shall we? So I am going to do a fair amount of screen sharing this week because of the nature of our conversation. So let's get to it.
When the going gets tough, the tough
Yeah, one of these days I'll get those clicks right, okay? Thanks for bearing with me. Anyway, to understand where the multiple comes through, we do need to break down what it is at its very, very core. And we're going to go math here today. And so strap on your seatbelts here. What the multiple is actually the inverse of something that's called the discount rate. So if you take the multiple and you divide it into 1, then you've essentially calculated the discount rate. And you're sitting there going, great, Martha, what the heck is a discount rate and what does that mean? Well, it's tied to some financial concepts around the time value of money and what you can earn on your money over a period of time. You think about it in terms of, think about it like an interest rate, because it's very much like an interest rate. But it's the interest rate that the buyer assigns to their investments and what they expect or want to get out of it based on their perceptions of the risk that they're facing and what their value of the money will be in the future if they go into this investment, such as buying your company. So think about it. If you get a loan from the bank, you pay one interest rate. If you get a loan from a payday loan shop, you're going to pay a vastly different rate. Well, why is that? Well, you pay one rate at the bank because the bank does their due diligence. They know what the risk is or is likely to be to give you a loan on your car purchase or your home purchase. They do the legwork and they have data to suggest what those risks are. A payday loan is much riskier in terms of, will the person that's taking the payday loan, the person that needs their money right now because they don't have any savings, but they have to pay for something right now, what's the probability of them being able to repay the loan? Well, it's probably a lower priority. There's a higher risk. And payday loan companies, like credit cards, they build in a factor of what they need to make, not just on their time value of money, but what they need to make as a return on their investment. So that creates their rates. The same thing is true of somebody buying or investing in a business. They have a view of the risk that is involved and what they believe the company will be able to generate in terms of future profits to not only pay back their investment, but to give them an additional return on investment. And that becomes their target for the return. So what we're going to do is we're going to really go deep here and dive into some of these concepts, because very often you might hear what the terms are, but not fully always connect the dots, or maybe you knew it at one time and it's always good to have a refresher. So that's what we're going to do here today. So let's start with the time value of money. The premise with the time value of money is that a bird in the hand is worth more than 2 in the bush. You would rather I give you $1 today than I give you $1 1 year from now. That's the essence of the concept, because you can take the dollar I hand you right now and invest it someplace else and potentially turn it into something more than just the dollar I gave to you today. Now, if I alternatively promise to give you $1 a year from now, you might be saying, well, crap, we're in an inflationary situation. Right now, I'm paying this at the gas pump. I might be paying twice that as at the gas pump next year. So that dollar you give me next year is only going to buy me 70 cents next year. Who knows? But that's essentially the thinking that you're using in terms of, if I give you a dollar today, what are my assumptions about the buying power or what that'll be worth next year in interest, factoring in inflation and growth and all these other financial factors. But the premise is the same, that a dollar, you give me a dollar today, it's worth much more than it would potentially be in the future. I'd rather have it now because I have control and can make judgments as to how I'm going to use the dollar today. Another way of thinking about the time value of money is if you've ever purchased a house and you've gone to the closing and you know that you are borrowing, let's say $200,000 for the house, and you're paying an interest rate of X. It doesn't really matter what X is. And you look at the schedules that they attach to the closing, and what they've done is they've mapped out what that future value ultimately is that you're going to have paid for that house over the 30 or 15-year mortgage. That number is a bucket big higher than $200,000. It's a number you look at and go, oh my goodness, I can't believe I'm doing that. Well, that, folks, is the time value of money. That's taking that $200,000 and applying an interest rate to it over the periods of time that you owe the money back. So those are the concepts that are at play when we're talking about a discount rate. It's just that instead of applying it to a mortgage, they're applying it to a different type of transaction. They're applying it to the purchase of your business and what that business will be able to kick off in terms of profits and cash flow in the future. So, ultimately, if you compare a present value of the dollar today to that future value, you can ultimately back into what that interest rate or that discount rate is. They are straightforward mathematical formulas is what that's all about. So essentially, what the discount rate is it's a way of expressing the interest rate that an investor is going to use to base their assumptions about how to price the value of the business. And they're going to factor in, well, if I have to borrow money to fund the purchase of the business, what rate is that going to be at? If if I could invest in this versus invest in that, what's the various rates on those two investments? If I could take the same amount of money that I'm going to put into your business and invest it in the stock market and get Y% out of it versus your X% out of it, well, what does that look like? So they're factoring that in and many other factors. And so that's really what they're looking at. And it's these assumptions that really make the difference as to whether the investment from the buyer's perspective is financially viable or not. And here's really the bottom line on that, is that it's the buyer that gets to set the rate. They're deciding the rate based on their assumptions and information about how they're going to structure the deal, what sort of rate of return they want to have, and what risks they see in the market and in your company. So I want to show you at a very, very high level how they actually build up their rate. when they are investing in a company, and it's called the build up method for setting a discount rate. And there are 4 pieces to it. Again, this is going to be at a very high level. There is not a pop quiz, but I want you to be aware that there are these 4 different pieces that a buyer considers when they're coming up with their discount rate, and as such, their multiple. Okay, so there are 3 pieces that really are based on I'll say market standards. So the first one is the risk-free rate for money. And that is, if you go and get a 20-year treasury bond, what is the rate that you would be paid on that? You and I can go look that up right now and find out what the current rate is for a 20-year US Treasury bond. That is known as the risk-free rate. So that's where this calculation starts. Then there are there's what they call the equity risk premium, and that is essentially a determination of what someone could earn in the stock market versus what they would get in the risk-free bonds. And there are tables and tools that investors and valuation analysts can go to determine what the current rates are for the equity risk premium. There is also what's known as a size premium adjustment that is made based on the size of the company. Now, a smaller company is higher risk. It doesn't necessarily have the same infrastructure or bandwidth or resources necessarily as a larger, say, multinational company. And when you are making an investment in a smaller company, you expect a higher return because you're taking a higher risk. So think of this in terms of the stock market and different portfolio choices you have. A large cap fund that you might invest with your 401k has a very different risk profile than the small cap, right? Small cap is riskier, so you expect a higher return for putting your 401k dollars in a small cap stock fund. Same concept is true when you're looking up the size premium adjustments. The 4th piece to this equation, the specific company risk rate, or I often turn those terms around and call it company specific risk rate, that really does depend on the company that the buyer's looking at. It is truly company specific. The first 3 numbers, the risk-free rate, the equity risk premium, and the size premium, there are tools for all 3 of those that sophisticated buyers and valuation analysts can turn to get their what that number should be based on what they're looking at. But when it comes to the company specific rate, they are truly looking at the specifics of the company, its industry, its products, its customers, its operations. Again, they get to determine and set what that is. And once they do that, once they add up all 4 of those numbers, they flip it over, and ultimately that becomes the multiple that is applied to EBITDA. So you'll remember when we first got started talking this morning that I said that the multiple was the inverse of the discount rate. So if the buyer looks at all 4 of those components and comes up with the discount rate of 20%, they're going to do the math, and a 20% discount rate, you divide 0.2 into 1 and you get 5. If their discount rate is 25%, well, that's 4. So essentially, that's what they mean by the inverse. So if somebody tells you that the discount rate is X, you can do the quick math and know what the multiple is, or vice versa. If somebody got a multiple of 3, you know that the discount rate was about 33%, meaning that the higher the discount rate, the higher the risk. The higher the risk, the lower the multiple. So they're just inverses of one another, and they're truly a measure of how much risk the buyer is seeing in this particular investment. So here's what you need to know in all this. Just as somebody can go look up the first 3, in theory, you could too if you really wanted to. I'd put that dollar on the table that I was giving you and put a bet that you may not go running off and look those up this afternoon, but who knows, you might. But here's what you really need to understand, and that is this concept of company-specific risk. You want to do your best to look at your company objectively, just like a buyer would do, and understand that you impact that company-specific risk every day you own your company. And it's not something as business owners we think about really hardly ever. But as we talk a little bit further, especially in our next segment, it will kind of become clearer as to how you are influencing it. You impact it every day. You impact that rate. But they're the ones that get to set it. I think I missed a slide, but maybe not. Anyway, so let's put this into a little bit of context. If you listened to or saw last week's show, you remember we were talking about Patricia and Tony, and that they had a difference of opinion on what their EBITDA was. They resolved that and agreed on the EBITDA number being the 2.1 million. So there's no difference of opinion there. But if Patricia is going to stick to her guns because she sees higher risk in Tony's business, and she's going to stick with her 33% discount rate or a multiple of 3, she's going to offer Tony $6.3 million for her business. Now, Tony is a classic entrepreneur. She is super, super optimistic about the future. She knows her products really well. She's designed really great products. She's more optimistic and believes that she should have a multiple of 5. Well, in that case, Tony, in her mind, thinks her business is worth 10.5 million. But Patricia's going to come in at 6.3. That's a $4.2 million difference, and that they either have to bridge, or conversely, Tony needs to get her head around, why is it that Patricia is seeing all this risk in the business? And what do you do about that? So, before you panic and think that you need to really understand how you're going to calculate all this at some point, don't worry. You won't necessarily have to do it. But this is what the valuation analysts go through and the buyers go through. And once you understand what company-specific risk is all about and how you influence it, I think it'll make more sense. So, as I said, you influence it every day, but that's not to say you get to tell the buyer or the person doing the business valuation what the company-specific risk should be. you don't get to articulate that. That's a judgment that they make. They determine it, and yes, it is subjective, and it'll be based on their experience working with similar companies, based on interviews and information that they collect about your company, and working with all sorts of companies throughout their career and their experience base. They do indeed get to set it, and they will do this analysis to understand how you compete, how you work with your customers and your suppliers. Who are your customers and suppliers? How are you managing the business? Is it you, or do you have a team? How are you operating? And all of that is what we are going to talk about in our next segment, so you know how you're influencing it and what you can do in your own business. So let's move on to our next segment.
Shake your money maker, shake your money maker, and then.
So let's talk about some of the ways that you influence the company's specific risk. There are a number of factors. Sometimes I call them value drivers. They'll be called purchase price factors or value factors sometimes. But I'll list some of the more common ones here in this segment. So the first three that I want to talk about are dependency issues. If your company is dependent on you, the owner, or if you're not the owner, is dependent on the owner for key relationships, for all the decision making, for a truckload of knowledge around the business, that creates more risk, because the owner presumably walks out of the door after the business is purchased, and all that knowledge, all those relationships and whatnot go with the owner. So that is a risk to the buyer, and whether they will be able to continue to develop and generate the profits and the sales and everything that goes into operating the business if the owner leaves. Will they be able to? Will they not be able to? In some businesses, it can be a huge deal. That's why developing a management team and creating, if you are the business owner, your goal should be to make your business as owner independent as possible. Building a management team, building your delegation skills, empowering others to do what you're able to do, cross training, having a team approach to key customer relationships, and so on. That's how you manage the risk of owner dependency. Speaking of customers, having dependency on a few key customers is a huge red flag in determining company specific risk. So I remember talking with a colleague, and he had a client whose business, about 75% of her business came from Walmart. 25% of her business came from other customers. That is a super high risk business. And yet the business owner thought, this is great. I've got Walmart. I've got a set flow here. It's a big dog. Well, yeah, it's a big dog, and it's a big fickle dog. If Walmart decides to pick up their marbles and go home, she's done. There's just no two ways about it. So having a more diverse set of customers and not being reliant on your top customers. If I think the rule of thumb is 10% of your business is tied up in one company, one customer, that's too much. And it elevates the company's specific risk, which will ultimately impact and create a lower multiple. Similarly is the case with suppliers. We've seen it with the pandemic in terms of how many companies were caught really flat-footed when they couldn't get their supplies because they were very dependent on one or two key suppliers for key materials. And now we're seeing it in the backlog and the logistics, the supply chain breakdown. Well, that is a situation where there's too much dependency on your suppliers. So those are the three dependency related aspects of company specific risk that you're making decisions on every day. Do you sell more to Walmart, or do you start hustling to get different customers in the door? Do you find backup suppliers for your key materials? Are you building that team so the company isn't dependent on you? And oh my gosh, the owner can go on vacation for 2 or 3 weeks and the place doesn't burn down. That's pretty cool, right? So the next set of aspects, key aspects, have to do more with your systems and how you're operating the company. And that is your financial disciplines. Are your financial systems current? Are your financial statements current, and are they accurate? Do you have talent in-house that's looking at those numbers and can help manage the finances of the system? And are you using your financial systems and financial discipline in how you're managing the company? They look at all that, and that is indeed a factor that is considered when assigning company specific risk. And then there are your operating systems. If I'm looking at your company and I have great aspirations to grow, let's say I think I can double the size of the company, but the systems are still like startup systems, well, I'm going to have to invest more money into upgrading the systems. So that is a risk and dollars that I'm going to have to spend. Another thing that they look at is how well documented are the systems and the procedures and the processes. Are they standardized enough so that if there's turnover in the workforce, we still have the institutional knowledge to run the company? You're making a decision on that every day you're operating your company, aren't you? We just don't think about it as often as perhaps we should. And that's really the essence of how a lot of this works in what factors are considered with company specific risk. And there are others. Those are just some of the key highlights that I know that as business owners, and having done a lot of work on the buy side as well as the sell side, I know that buyers look at, and I know what kills deals. Owner dependency, boom, they're out. The company specific risk is so high that it's not, they don't see the return on investment being there. So, it really is interesting to factor that in and know that a company specific risk is somewhat controllable on your behalf as the business owner or in operating the company. And there are things that you can do every day to build the strength, and ultimately you're building the transferability of your company. And that's what the multiple reflects, is how well you have taken the risk out of the company for the buyer and made it easy peasy for them to step in and be confident that there is tremendous upside for them in the deal. So that's the mysterious multiple. And as you can see, we covered a lot of ground, but no, they don't pull it out of their ear. They don't pull it out of thin air. there really is a method to that madness, and there are formulas and analysis that goes into it, and you can start today to strengthen your company and reduce your company's specific risk, and thereby grow value every day as you are operating your company or within your company. So that takes us to our conversation for today. So thank you for joining us. We love it when you are here for the conversation. And if you're here, stick around for the Ask Me Anything session. We're happy to field your questions there, or feel free to email your questions to ESR, stands for Exit Stage Right, ESR@providencehill.com. And I do want to tell you about some of the workshops that we have at Providence Hill. We offer two. One is our Get a Grip workshops. The April Get a Grip has been closed for registration, so the next Get a Grip will be in July, and that is really an introduction to business value and how it fits into your own personal financial plans, really is what Get a Grip is. And then we build on Get a Grip in our Finding True Value workshops, and we have one of those coming up starting in June. So by all means, check that out. I'm gonna give you a screen that you can go to, here we go. We'll give you those links and the QR code. If you want to go directly to the workshop page, you can use the QR code, or check it out at our workshop tab in the Providence Hill website. So this is Exit Stage Right. We are happy that you're here today. And this is where we talk about ways that you can build, buy, and sell your business so you can exit stage right into your next adventure and meet your financial goals. I'm Martha Sullivan, and I have a really good feeling about this. Go transform your business and exit stage right. There we go. Thanks for joining. See you next time.